Smart beta versus traditional commodity diversification. Which is better? Imagine trying to balance a basket of fruits. You want variety to avoid overloading on one type. That's what diversification in commodities is all about. Now, there are two main ways to do this. Let's explore them. Traditional commodity diversification involves spreading investments across different types of commodities like energy, metals, and agriculture. The goal is to reduce risk by not putting all your eggs in one basket. It usually uses market capitalization or equal weighting, meaning bigger or equally weighted commodities get more investment. This approach aims to follow overall market trends and smooth out volatility by capturing different supply and demand patterns. Smart beta strategies are quite different. Instead of just going by size or market value, they pick commodities based on specific factors. These factors could be value, meaning undervalued commodities, momentum, which focuses on commodities showing recent strong performance, quality, emphasizing commodities with stable supply and demand, or low volatility, aiming for steadier returns. These strategies follow set rules and use data-driven models to build portfolios that try to improve returns or reduce risks better than traditional methods. One big advantage of smart beta is better diversification. By weighting commodities based on factors rather than size, it avoids overexposure to the biggest commodities like oil or gold. This can help prevent your portfolio from being overly dependent on a few large players. Smart beta can also potentially boost returns by focusing on factors that have shown better performance over time. For example, if momentum works well, a smart beta approach might tilt investments toward commodities with recent gains. Another benefit is risk management. Strategies that focus on low volatility or quality tend to produce more stable returns and can help limit losses during market downturns. Plus, because smart beta portfolios follow clear, rules-based methods, investors can understand exactly how their investments are chosen. This transparency makes it easier to stay consistent with your strategy. However, smart beta can cost more than simple passive commodity indices because of the extra research and data analysis involved. It also might behave differently than traditional indices, especially during unusual market conditions. Traditional diversification is simpler and often cheaper, making it appealing for investors who want broad exposure without tilting toward specific factors. In practice, many investors combine both approaches. They might hold a broad commodity index for general exposure and add a smart beta fund focused on value or momentum to try to boost performance. This way, they get the benefits of both worlds. In the end, smart beta offers a more targeted, factor-driven way to diversify commodities. It can help improve returns and manage risks better than just spreading investments across different commodities equally. But choosing between them depends on your goals, how much you're willing to pay in costs, and how much risk you're comfortable with.